Most Australian property investors get to one property and then they stall for years. Here's what's actually sitting in the way. The journey from one investment property to two is probably the most common sticking point I see in this space. And I think it's underappreciated how different the second purchase feels from the first. The first time you buy, there's a kind of momentum that comes with starting. You've made a decision after a period of deliberation, you've got energy behind it, and the novelty of the process carries you forward. The second time, you've got one property already, which means you have something to protect, something to lose. You understand more about what can go wrong. The experience of the first purchase has probably given you a much more realistic picture of the friction involved. And so the second decision often feels heavier than the first, even though objectively you should be better equipped. And I want to work through the three structural barriers I see most commonly sitting between investors and their second property, because naming them accurately is the first step to addressing them. The first barrier is serviceability. After your first investment property purchase, your borrowing capacity has changed. Lenders have already seen one investment loan on your file. They are now assessing your capacity for the second loan against a financial picture that includes the first loan's obligation, as well as your primary residence mortgage if you have one, personal loans, credit card limits, not just balances but limits, and any other liabilities. The rental income from your existing investment property does count toward your serviceability assessment, but lenders apply a shading, typically using 80% of the rental income in the assessment rather than the full amount. This is to account for vacancy and management costs. So the rental income helps, but it doesn't fully offset the new loan's obligation in the serviceability calculation. What this means practically, you cannot assume that your borrowing capacity for the second purchase is similar to your capacity for the first. You need to get your current position formally assessed by a broker or a lender, with all of your liabilities and all of your income accurately reflected. And you need to do this before you start looking at properties, not after you've found one you want. I've seen too many investors get well into the process with a second property, due diligence done, offer made, genuine excitement about the asset, only to discover that their borrowing capacity doesn't stack up the way they thought. That's a painful outcome that's entirely preventable with a current finance assessment before the search even begins. The second barrier is equity. You may have heard that you can use equity from your first property as a deposit for your second. This is true in principle, but the execution has a few nuances that often catch people out. First, the equity needs to be usable, which means the lender needs to be willing to lend against it. This is typically assessed via a formal valuation of the first property, not just the price you paid or an estimate from a real estate portal. If your first property has grown in value since purchase, the formal valuation should reflect that, giving you more accessible equity. If it hasn't grown or if it's grown less than expected, the equity position may not be as strong as you assumed. Second, the LVR constraints matter. Most lenders will lend up to 80% of the property's value without requiring lender's mortgage insurance. So if your first property is worth $700,000 and you owe $500,000, your equity is $200,000, but only the portion above 80% of $700,000, which is $560,000, is generally accessible without LMR. That means you may only have $60,000 of usable equity rather than $200,000. The maths is often more constrained than people expect. Third, you need enough equity to cover the deposit on the second purchase plus purchase costs, stamp duty, conveyancing, potential pest and building, and a buffer. The deposit alone isn't the full amount that you need. Get a formal assessment of your usable equity from your broker or lender before you start searching for the second property. Know your actual position, not your assumed one. The third barrier is decision fatigue and analysis paralysis. And this one is more psychological than structural, but it's just as real. By the time you're looking at a second purchase, you've been through the first one. You know that things can go wrong. You know that a property that looks fine on the surface can have hidden issues. You've probably heard stories from your network, from the content you consume, about investors who made mistakes that cost them years. And because you now have something to protect, the downside risk feels more visceral than it did when you were entering the market for the first time. The result is often what I would call circular research. You gather information, you get close to a decision, you pull back, you gather more information, you get close again. The research loop continues without ever resulting into a decision. Fix for this is a well-constructed brief. And I know I've talked about briefs before on this channel, but I want to make the point specifically in the context of the second purchase. A brief resolves the circular research problem because it predefines what you're looking for. When a property comes up that meets all the brief criteria, the decision isn't, is this property good enough? That's the question that drives the circular loop. The decision is, does this property meet the criteria I've already established through a clear headed analysis? That's a much more answerable question. And it allows you to move with confidence rather than with persistent doubt. If you are at that exact point, you've got one property, you want to build to two, and you're not sure what's actually blocking you, the discovery call at OV property buyers is worth doing. We can usually identify the barriers quickly and give you a clear path forward. Link is in the description below. Let me now give you a practical framework for the second purchase process. Step 1. Get your current borrowing capacity formally assessed. Not estimated, formally assessed. That's the starting point for every other decision. Step 2. Get a formal valuation on your first property and calculate your usable equity with your broker or lender. You need to know exactly what financial resources you have available for the second purchase. Step 3. Build your brief. Define specifically what the second property needs to look like in terms of yield, location criteria, asset characteristics, and risk profile before you even start searching. This is the step that prevents the search from going circular. Step 4. Begin the search within the brief criteria. Shortlist only properties that meet all of the predefined criteria. If nothing meets the criteria, the answer may be to wait until something does, not to adjust or expand the criteria just to fit something you found. Step 5. Due diligence. Full asset level and market level due diligence on any genuine property before an offer is made. That's the process. It's not complicated, but it requires discipline. Particularly the discipline not to start searching before steps 1, 2, and 3 are done. Those steps protect you from the most common ways the second purchase actually goes wrong. The investors who successfully navigated this path and built to 3, 4, 5 properties are almost always the ones who treated each purchase as a standalone, fully prepared decision rather than a continuation of momentum from the previous one.